Can ETH reach $150,000 in the next 2 years? Well, that's what the triple halving theory predicts. You're probably super skeptical right now, and no lie, I was too. When I first heard about this theory, I wrote it off as a meme. I was like, it was probably invented by some moon boy YouTuber, right? But no, it's actually a legitimate thesis, and somebody wrote a 77-page institutional style report about it, with super unique and thorough analysis that I haven't seen anywhere else in the crypto space. And after reading all of it, not just once but twice, I gotta say it does seem more reasonable. So if you want to strengthen your conviction in ETH, but don't want to read the whole thing yourself, then this video is for you. Strap in, my friend, and let's dive right in. Okay, so this video is going to be pretty different than all my other ones because I'm going to use a lot of slides for this one, and it's going to be quite long. But that's because this theory is really complicated, and my goal with this video is to help you wrap your head around it as an Ethereum investor. So I'll also leave you timestamps down below if you want to skip around, but I really recommend you to watch the whole thing because I promise you it's going to be worth it. All right, so here's what we're going to cover today. First, what is triple halving anyways? 2 is the key part of it, right? A flows-based theory of asset prices. This is what this whole theory is going to be based on. And then we're going to look at the Bitcoin halvings through this lens, and then Ethereum through this lens with all the different bits and pieces. And then we're going to ask the big question, right? Are these flows priced in? Then we're going to look at the $150,000 per ETH price target and talk about why it's possible / reachable. We're going to look at how it might play out, how does this thesis potentially fail, and me, Kevin's personal conclusions. First, a shout out to Nikhil S. He's actually an MD, so he's a doctor, but he's also super passionate about investing, and he writes his own investment newsletter. You can go follow him on Twitter at squishchaos. And to write this report, he combined other research and analysis with his own to form this beast of a 77-page report, right? And so what I'm going to do in this video is to break it down and explain the key components. And I'll also link below his original report as well in case you want to read it for yourself. So why is it called triple halving, right? Remember, Ethereum recently had the EIP 1559 upgrade, and in the future, we're going to have proof of stake coming soon. So both combined, it's going to lead to a 90% reduction of issuance, which is sell pressure, right? So the 10% remaining is about the same as if you take 50% times 50% times 50%. So each 50% slice is a halving, right? That's why it's 3 halvings or triple halving. Now, it's not as simple as saying that ETH is going to just rocket 9x with this 90% reduction, right? Because we need to understand something called flows first. So what is this flows-based theory of asset prices, right? Basically, it says that price depends on the flow of money into and out of any asset. Pretty simple, right? It's supply and demand. For example, like if you have constant supply plus increasing demand, then price rises. So the question is, can we model supply and demand flows specifically for Ethereum? And some other concepts that will matter in this discussion is elasticity, and that's how does the change in price affect how much you're willing to buy or sell? Number 2 is liquidity, is can you buy or sell without affecting the price? Number 3 is volatility, or the degree of variation in price, right? So these concepts plus the flows will determine the price. So this is just your typical picture, right, of supply and demand curves and how price and quantity changes depending on if you shift demand up or down or if you shift supply up or down. Now, there are a few types of flows we've got to understand first. One is structural, right? These are forced changes to supply that cannot be moved by price. So some examples for you: halving events, miners selling to pay taxes because they have to do that, buy and hold forever index funds, IPO lockup expiration, right? They can't sell until the lockup date is there. Government bans, in that case, you can't buy even if you want to. Short squeezes, margin-based deleveraging. For those cases, you have to transact regardless of the price. And then forced structural flows, these things are predictable and price insensitive, right? They happen regardless of the price. So this is an important edge that if we can model and understand, it should help us out. The second type of flow is systematic. These are like your funds with investment mandates, like, oh, I'm going to invest in innovation or DeFi only, things like that. And then quarterly rebalancing, tax loss harvesting, and so forth. And then the third and last type of flow is discretionary. These are flows that we know exist because they show up in the exchange data, but we can't identify what they are exactly. Like it could be institutions or random retail investors piling in. If you remember efficient market hypothesis, that assumes that these discretionary type of flows dominate and respond to new information and cannot be predicted. And these flows are also dependent on narratives, right? Which kind of drives the price, and then price drives the narrative on in a reflexive cycle. So what you got to understand is that crypto doesn't actually have to change the world to move money into it. Just the belief that crypto will do so will move money into it. There's a big difference here. So some case studies of these flows are, one is Tesla. They rocketed before and after joining the S&P 500. Like we thought it was priced in, right? It was rocketing beforehand. And then when it rocketed after, we're like, what's going on? Well, maybe that's because of structural ETFs buying it, right? There's ETFs that track the S&P 500. So they're kind of forced to buy Tesla, but not before it's officially added. And for IPO lockup expirations, these are a type of flow too, but it's hard to price these in, right? Because conventional knowledge is that they depress stock prices. So if we know that stocks go down when IPO lockups happen, then why can't we price that in? But that's because investors wait for the lockup drop to happen and then they don't buy, right? So price drops more easily because there's less demand. People are waiting. And then the insiders who have the lockup, they get worried because price is dropping. So when it finally opens, they market sell and the price drops more. So it's like a self-fulfilling prophecy, right? Here is example of the Tesla chart. You can kind of see how it had the first rocket, went sideways, it got added, and then rocketed again until supply emerged, right? So that's the question. Can these be priced in, these flows? And the argument here is no, because this isn't about the factors that affect flows. This is about the flows themselves. So things like narratives, those can be priced in, right? But not market structure. Just think about options hedging. You can't price that in because it depends. If you try to anticipate it and then you like buy or sell a lot, that changes the underlying market structure, and then the hedging that they do will be completely different. So you can't predict that in advance. Thinking about flows, right? They can give us an edge if we understand them, and also the elasticity. And the last thing here is that structured flows can't be priced in because they aren't reacting to new information. The underlying structure must change first for the structured flows to happen. So first, let's take a look at Bitcoin's halvings through this lens, right? There's structured and discretionary flows. Before the halving in 2018, we were trading under the volume weighted average price for a long time. So price was very elastic, right? Because the people who bought the top, they have tofu hands and they sold as soon as they were near break even. They're very sour, right? And so that created more supply and liquidity and stopped any upwards price action. However, a huge point here is that Bitcoin has hodlers like you and I who stack sats faithfully no matter what the price is on a recurring basis. So these are inelastic demand flows, right? Inelastic because we don't care what price it is. We're going to stack sats regularly. So the thought is that we need to eat through the elastic overhead supply before the cycle can repeat. This is the transfer from tofu hands to diamond hands. And here is just the example. The thin blue line you see is the volume weighted average price. And you can see in 2018, after the blow off top, how the price traded under that VWAP line until it can finally eat through all those weak hands. So that is maybe why ETH fell way more during 2018 bear market, right? Because there's no similar culture of stacking. And we got to remember that halving affects miner flows because remember, they sell the Bitcoin that they earn to pay the bills, but the selling pressure halves by the halving. So think about the inelastic stackers and holders, right? They have the same amount of demand, but now half of them do not have a price insensitive miner to buy from anymore because their rewards halved. So now they have to buy from weak-handed investors instead, but those people are not as price insensitive as miners. So that causes upwards pressure on price until new liquidity pockets emerge at higher prices. Now, you may be wondering, like, why does it take for months for the price to rise rather than it to explode on the day of the halving? Well, think about it, right? Because the miners' market sell orders are small compared to the total supply. So it takes time for the inelastic demand to chew through elastic supply. And so once we have hopium enter the market by people shilling, that creates more sat stackers, which is inelastic demand, which causes the price to rise, and the cycle reinforces itself over and over again, right? So this edge is really small, but it persists through time. And you got to know, though, that big shock events could overwhelm this, though. Now, when the price increases, this drives narrative adoption too, right? More people start to believe in the monetary debasement, in hyperinflation fears, things like that. And that is what brings in those discretionary flows. And we see big investors like Paul Tudor Jones and Stanley Druckenmiller, they bought and they'll hodl too. Now, to understand this lens, you don't have to believe in Bitcoin as a store of value for this to make sense, right? You just have to analyze how other investors are likely to adopt this narrative. And that's how you can better see how this 4-year cycle drives flows. And phew, that was Bitcoin, but now onto Ethereum. Ethereum is special because its structural supply outflow comes from DeFi and ETH staking. Right? This is what forms the Ethereum HODL community that didn't exist before, unlike Bitcoin's. Because for ETH 2.0, we see people staking their ETH before they even get rewards for it. So if people stake it and leave it, that is super inelastic, right? It's just like doing passive investing, the buy and hold forever index funds. So right now in August, we have roughly 6.5 million ETH staked, which is about 5.55% of the total supply. And besides that, DeFi also causes massive outflows, right? The total value locked has rocketed, and the amount of ETH on exchanges has dropped rapidly as well. So with less liquidity, that's going to lead to more volatility for ETH. And here's just a picture of the amount of ETH staked in the Beacon Chain smart contract, right, that I talked about earlier. And then here is DeFi Pulse's total value locked in DeFi, which is super high, right? 75 billion. But this is all going to get more inelastic in the future. And ETH supply could be even more inelastic than even Bitcoin's HODL culture. Here's why. Number one, it's because the trend of staked and locked ETH is accelerating, and we can only expect it to get greater after staking rewards takes place. Number two is that Ethereum never had a halving event before, whereas Bitcoin has had several. And Ethereum's merge to proof of stake is going to reduce elastic supply by 90%. And then we may have an Ethereum ETF, which may come with structural demand built in, and also just growing illiquidity on exchanges, right? These things are not priced in because the flows have not come online yet. Some key halving events for ETH, right? EIP 1559, this already came online. 70% of transaction fees will be burned, while 30% will be sent to stakers. At some points, it could be net deflationary depending on transaction fees and usage. It could reduce the supply even more, right? And this is the ultimate form of inelasticity possible. Current daily sell pressure is 22,000 ETH per day. And after EIP 1559, it's estimated to be about 15.7 thousand ETH per day. And after merge to proof of stake, analysts estimate that it will drop to 2,000 or so ETH per day. So that's how you get the 90% reduction, right? 22,000 to about 2,000. That's why it's called the triple halving. And there's a lot of dashboards like Watch the Burn where you can see how much ETH is being burned, almost like 8,000 per this screenshot. And here is a great diagram showing the issuance rate that you can get on the Ethereum GitHub. And this yellow issuance rate is what you have to see. And the axis is on the right-hand side. As you can see, the last phase, the drop off to the very bottom, is ETH2 phase 1.5, right? This is the merge. It's going to go really low in terms of issuance. So what about the flows though? Because that's what we care about. Structurally speaking, the proof of stake has much lower issuance, which is going to be a huge effect. But you got to remember, this is going to be a small amount compared to daily volume. So just like Bitcoin's halving, it's going to take time for it to fully kick in. It should have a bigger impact though, because it's 3 halvings at once. And then EIP 1559 just launched recently. It merged hopefully in Q4 of this year or early 2022. There's also systematic supply outflows, right? Because staking will increase and that's going to reduce the overall liquidity. that's going to only go up because the merge will let you remove your staked ETH. And there's also going to be DeFi options for SETH, which is a token that represents your staked ETH, right? So a lot of people are going to be staking. And also you're going to get some juicy yield, which depends on how much is staked. Like let's say 4 million ETH is staked. That's going to be 69% yield. If 6 million ETH is staked, around 25%, and 15 million ETH staked, around 7%. Just FYI, this yield seems really high, but that's because it calculates both issuance and their cut of the fees, and not just one of them. So with high yields, people want to buy ETH and stake it, right? So that is a huge supply outflow, right? Less for people to buy because it's going to be just sitting there being staked. And yield is price insensitive too, so that's huge, right? Because you get 25% yield in ETH, whether ETH is at $3,000 or $8,000, right? So that can be a lot of USD, which would be crazy. And that's what I was saying. It's going to be very illiquid and super volatile. So in terms of discretionary flows, these are based from narratives. And we got to ask ourselves, how strong are these narratives? Things like ultrasound money due to a potentially deflationary supply, programmable store of value, Ether giving you money incentives forever, dividends, like why would you ever stop storing value with it? Maybe climate change or ESG funds might like it. Or when ETH finally scales, we can see how powerful it can be. We saw Binance Chain rocket, right? With addresses because it was fast. ETH is going to take all those back potentially. And also just its address growth so far has been incredibly impressive. So Metcalfe's law tells us the value of the network is great with a lot of addresses. And then we have NFTs, DeFi, who knows what's coming next. And then also if and when ETH flippens Bitcoin, that can bring some outflows to ETH as well. So this is just a quick chart of the ETH unique addresses continuing to grow. And the orange line is Binance Smart Chain rocketing because it was fast. This can just show us the potential of ETH in the future when it scales as well. Flows from ETFs. Once Ethereum ETF comes, after Bitcoin's of course, we will have those structural buying and selling. If billions of dollars flow into the ETF, they have to buy ETF no matter how illiquid the underlying is. That is a huge component of these flows. And the ETF can stake too and provide a dividend. So this is just going to reinforce HODL behavior. Just buy and forget and collect a great yield. I mean, look at Canada's ETFs for Ethereum, right? That already has huge volume. So we can expect it to be something similar for the US ETF. Now, the big question is this priced in? Like I said earlier, no, because structural flows can't be, but discretionary ones could be. But are they? It doesn't look like it. I mean, CNBC hasn't talked about ETH too much. The ETH BTC ratio still isn't rocketing yet. Search traffic of ETH compared to BTC is not too high yet. And people still think about ETH in 4-year cycles, which means it hasn't decoupled from Bitcoin yet. And ETH will likely write its own narrative eventually because there's no reason for us to expect ETH to operate in 4-year cycles. ETH doesn't have halvings like that, right? But people still anchor ETH to BTC in their mind. And that's why the argument is that it's not priced in. So here is the chart of ETH search volume to Bitcoin search volume. You can see it's not that high yet. And here is Ethereum's Bitcoin ratio. It's doing better, but still not breaking out even. And then Ethereum's red mentions on CNBC is way lower than Bitcoin's. So the target ETH price that Nikhil gives is on January 1st, 2023. Base case, $30,000 to $50,000. And he derives this by looking at various popular valuation models like discounted cash flow model, comparison to payment networks, Metcalfe's law, stock to flow theory. And he says that he expects his base case price to be long-term price if he's wrong about all of these flows. But his target peak price for euphoric times is $150,000 per ETH. And he looked at all those flows to estimate this peak price because it's going to be super liquid based on a lot of people staking and DeFi. It's going to bring new demand. On-ramps, there's a lot of on-ramps, funds coming in, ETFs, ESG, and then the catalyst are these two things, EIP 1559 and proof of stake, which will lead to a 90% reduction in issuance. And then finally wrapped together by the narrative, ultrasound money, massive address and activity growth, yields, NFT, DeFi, all of these combined together make up the flows that could lead to a blow off top for $150,000. How is this going to play out though, right? He expects ETH to reach around $20,000 or so and then people start selling and shorting thinking it's over, because that's a lot of people's prediction and target. But then short sellers with extreme leverage will come, and yes, the price will drop initially, but with new organic demands flows coming, this could cause shorts to force to cover and lead us to a massive second leg up. But he also says that if we hit $150,000, we will likely drop really fast back down to around like 50K. So we saw these kind of short squeezes, right? This is Tesla. It rocketed, came back down, but then rocketed way more, right? Because of shorts and all those things. So maybe a case we can look at. But we got to talk about the elephant in this room, the insane market cap, because ETH at $150,000 is a 16 trillion market cap, which is loony time, okay? It's crazy to think about. But it doesn't mean that that much money needs to flow in to reach it. Because if it's super illiquid, it can get there easily, right? The amount of money needed to move price depends on liquidity after all. So less liquidity means smaller flows necessary to move the price more. Just look at GameStop, right? It didn't have tens of billions of dollars flowing in to move it that high. It was a combination of diamond hands and Wall Street bets wanting to squeeze those hedge funds. So it wouldn't be right without talking about some ways that this could fail. And Nikhil writes, like, if the proof of stake merge is delayed too long, if transaction fees are too low for fee burn to be meaningful, or maybe the bear market starts sooner and outflows tank the price too much for the triple having to have an impact. Or maybe the global stock markets tank and bring ETH down with them. Or no ETF is approved anytime soon. Or there's regulatory risk if ETH gets too big and in the crosshair of regulators. Or ETH monetary policy gets changed to be inflationary. Or he could just be right and it reaches like $90,000 or so rather than all the way up to $150,000. Here's my thought, okay, because that was his analysis and his commentary. I think he's a little bit too optimistic, right? I do think ETH will likely flip in Bitcoin eventually, but I don't think ETH breaks from Bitcoin in this cycle. And I don't think we get an ETF until probably 2023 at the earliest. So triple halving will play a role, but much slower than expected. And I also don't expect ETH to be always net deflationary. I think there are some portions of time where it will be, but a lot of times it will just have really small inflation. And another thing is regulatory and global markets risk, I think, is much higher than we may think. My target, if we have a double peak for Bitcoin, is around $20,000 to $30,000 for ETH. And I think next cycle, ETH does break from Bitcoin's influence. So we could get to $150,000 eventually, maybe in like 5 years, but not so soon. So that's it, folks. Let me know what you think about this if you have any questions down below. And also be sure to watch this video about super cycle theory, which is a theory about Bitcoin reaching $1 million in the next year. But also theories are oftentimes wrong, like stock to flow model for Bitcoin. Here's my analysis why in this video. Anyways, I'm Kevin from BFB. Let me know what you think about this format, and I'll catch y'all next time.